And here we go again. 2025 is finally here, and we are about to go ahead with the first official weekly market recap of the year 2025. Now, uh, not a lot, to discuss when it comes down to news and macro data points, because of course the week was interrupted by New Year Eve celebrations and whatnot. And if you check the economic calendar, was a bit shallow as well. We got the unemployment claims, but as usual, nothing really changed. We are still in this range, so nothing really worrying so far. There are many other signs of cracks in the labor market, even in the US, but they're not being picked up in the unemployment claims so far. If any, um, I'd say maybe if you start to look as we did in the past, the average, the length of time that people now stay on the unemployment line compared to before, it's ticking up a bit. So that just means that if you lose your job, it was easier before to find another one, and now it starts to be a bit more tricky, a bit harder. So that could be a crack which is manifesting itself. But other than that, the data are not really picking up a lot. I guess we're gonna have a bit more clarity on it. Assuming just one single data point could provide clarity on the whole macro picture, but we're gonna have a little bit more of clarity on the topic next week with the employment data coming out. Other than that, ISM manufacturing PMI still in contraction territory since this is a diffusing index, but nothing really changed. We're still stuck in this range, which basically tells you that the industrial sector is still in contraction. And guess what? It's been there for quite a bit of time. Did the overall economy give a shit? No. Did the market give a shit? No, because at the end of it, the industrial manufacturing sector in the US, it's not a huge component of the overall economic output because they are a 70% consumption type of economy. So production, it's not really the core of the business as for the global picture for the nation. Next week, on the other hand, as we said, we are gonna see what's come up. Um, yeah, a lot of stuff coming up. To be fair, like jobs opening. We are gonna have the services PMI. This might be a bit more interesting to look at. The ADP non-farm employment change, and of course a little bit of FOMC meeting minutes. Usually, yeah, they come out uh, later in the day throughout the middle of the week. A little bit of assessment by the FOMC. It's not your usual FOMC meeting like the one where they set the monetary policy or they discuss rates now, but it's just an intermediate type of assessment they give out. Could move the market, yeah, it could. Then we're gonna have the non-farm payrolls, of course, and the unemployment rate, which again, I guess it's going to be followed by a lot of people because we are tipping into a dangerous territory here now. If we start to crack above 4.4, 4.5, it could be a catalyst for markets. But that's going to be a topic for next week, I would suppose. So for now, let's stick to this week, and let's start out checking out oil. Finally, oil seems to have taken a direction. It's just I was anticipating weaker prices for oil, and I've been doing it for you know an eternity now. Does this move to the upside change a lot in the grand scheme of things overall? Not really. I would guess up until the point we do trade in this range in between the 80s or the high 70s and basically the high 60s or 70s. We're still in a range overall on a macro picture. One thing interesting was on this high right here, I was checking the break evens, and it looks like if you check, this is basically the high which was put in on November the 6th, and now we finally traded above it. But if you check the same high and the break even, which should be this one, yeah, basically this one right here, right? November the 6th, right? They're still not following along with price action. Now, again, as any other type of divergence, before starting to put a hell of a lot of weight onto it, you would need to see at least a local high confirmed in price action. Then you can start to compare the two divergences, because what you might get is that all of a sudden the break even starts to actually tick up following the price of oil. So you would need to see a little bit of a top, a local top being put in here, and if at the same time break evens are actually starting to confirm a little bit of a pullback, then you know you got an actual divergence. Again, we're talking macro here, so it's not one day, it's not one week. You need to check this stuff as medium to long term trends type of things. Otherwise, you really take the chance of stumbling upon a lot of false signals, which actually are not really signals. It's just you front running stuff, right? So pay attention to it. Um, there's still that talk about the energy market and the potential interplays in between oil and nat gas, because as you've seen, nat gas had a little bit of an uptrend in these recent months, starting out after the summer. Now, part of it, I would say, now we are looking at the NYMEX futures contract. So again, it could be different in other parts of the world. Like in Europe, of course, you got the same type of quotes for nat gas, but they are quoted at the Amsterdam Exchange, as far as I can remember. It became sadly famous throughout the first stages of the Russian-Ukraine conflict. Um, so first of all, technicalities. This is looking like an uptrend. Now, where could it go? I mean, we have tapped into a lot of different levels now, and we finally broke out of them. I'm talking about these and these. And by doing so, we built up a little bit of a, it was constructive as a movement to the upside. We might get in another study step, maybe at these levels right here, I'd say. But I mean, let's just say this actually has the potential to really tick up a bit higher. 4.5 or 5, even round number, could be into this apex. Uh, Probably it's gonna be even if it gets there, it's gonna be volatile. As you can see, this asset has a tendency to be particularly volatile. Um, I already talked about this potential arbitrage in between oil and nat gas. Uh, didn't really check the ratio in between the two. Is it closed yet? It is not closed. I would guess with oil moving a little bit higher, that still leaves the doors open for these type of arbitrage to be performed, or to be exploited. But we'd need to reassess that with a bit more details. What's interesting, I mean, it's pretty evident just by looking at the charts. But if you want another chart to confirm what you already see, it could be this. Now, this is the average volatility for nat gas throughout the different months of the year. Now, of course, it's pretty evident and it's pretty logic that both January and December they see the highest print on volatility because what? Well, because of seasonality. If you check in the US now, they got some sort of a weather alarm that there is this massive glacial storm about to hit a huge chunk of the country. They are forecasting temperatures to drop, a lot of snow coming down from the sky. And what you get? Well, you get people not going out so much, staying home. And if they are staying home, they need to heat up the home. How do you do that? Well, you just burn more nat gas to produce heat. So there is a tendency of demand going higher throughout the winter. You know, that's not rocket science, of course. What's a bit more interesting could be You would expect throughout, of course, throughout spring and the summer, volatility tends to come down a little bit because demand is coming down. The weather is warmer, so maybe not the same amount of need for nat gas to heat up offices, houses and homes, and, well, basically civilians type of constructions and buildings. But you tend to have a little bit of a spike in volatility when you get to the end of the summer. So August, September, as you can see, it's kind of a little bit similar in Europe. This is basically when you get not only the entities, the actors which are playing in the energy market, but even from some sort of a geopolitical standpoint, and especially recently, we've seen how it could be vital and crucial. You get a little bit of a tendency to restash your reserves of nat gas, for the winter. Uh, Economically, it might be even convenient. Like I start stocking up on nat gas reserves when it's still relatively cheaper and less volatile, anticipating the spark of demand throughout the winter. So I would be able to sell at higher prices if I bought in a bit earlier. So, that could be another dynamic which overall contributes to give this chart the shape it got. All right, so that's it for nat gas. What about gold? Last time we checked gold, we were looking at this sort of a secondary rejection. And if you remember, the assessment was at this point, if you really believe this market is about to come down quite substantially, you would need it to see it going right here, right now. Because after two tests in what was deemed as previous support, now flipped resistance, if you don't see continuation, if you don't have follow through, chances are you're going to reclaim the level. And guess what? Two strong days, we got back about a level and we closed right above it. Now, does it does it really mean a lot overall? Um, Beside usual liquidity and levels interplays, I would say maybe not. Like it's not that just because now we have reclaimed this level, we mathematically get a free ride to the upper side of the range, right? It could be like this, maybe, right? A lot of people might expect that. Could also be we just keep on ranging into these old dealing range that we got, so it might be a bit choppy right around here, right? Same as we could just keep on uh, trading sideways and slightly down, and at the end of it, what you get is establishing maybe a new dealing range, which you can't see now because it's not established. You would need a sharp drop before it, but I guess overall, the way I see it, the more time gold can hold this range, the more you have a case for higher prices into the future, right? Does it have to come all in one blow and right here, right now, maybe next week or throughout the month of January? No. As we've seen in the past, this market can stay in a choppy environment and into a prolonged consolidation for quite a bit of time. And, you know, that would be, in this case, considering the overall trend, right? That could be a positive sign for gold bulls at the outset. But just taking it week by week, I would be particularly neutral. If anything, maybe 60-40, right? Unbalanced for a little bit of another attempt to the upside, but really not a lot of faith on a huge directional move coming off of this specific level right here. So just watching it. I still have positions into it. So right now I'm trying to keep my cool. And other than that, up until something drastically changes, I'm not gonna take action on those, right? Bitcoin, what we got on Bitcoin? Another bounce. It's moving a little bit like, not exactly, but you know, It's kind of like gold. It's always there. It looks like it's about to crash, and then nope, they bring it up once again. And this has been the theme, right? With Bitcoin, with gold, with many different things, even the stock market. Everyone was looking at it. It looks weak. It looks weak now. This time, really, it's really gotta go. This is time it goes to the downside, of course, and then it doesn't. So again, now we still got this level to clear. If you want to have a little bit more faith into an up move toward what could be 117, let's just say for the sake of simplicity, 120k region, but you would need to clear these high first. And again, after periods of huge expansions, it is normal to have these type of a choppy movement, right? um, I defaulted back to this type of behavior we've seen. If you remember, it was maybe a month ago. After a long consolidation, a sharp breakout, the market, especially in Bitcoin, it tends to keep on climbing to the upside, but it gets much more choppy and volatile intraday. That doesn't mean that just because you see it slowing down the pace a little bit, it's doomed to get back down. And we're looking at it right now. We got kind of the same type of behavior: long-term consolidation, sharp move to the upside, broke out of the range, made new all-time highs, and now it's just you know, you could say climbing. I would be much more confident in saying climbing if we can again reclaim this level, but so far at least it's not breaking down. And again, once you got these sharp breakouts, the more it can hold new type of dealing range, the better. You start to build up that acceptance at a higher prices, which is again just the market coming back into balance and accepting a new type of a dealing level after being auctioned to the upside. So again, just it's kind of the same for as it was for gold. Up until the point it is below this low and above these highs. I actually I actually said it backward. Sorry. Up until the point it is below these highs and above these lows, I don't really see a lot into it. Now, again, we know this is Bitcoin, so it could be particularly volatile. The same way this move was protracted to the upside, it could be as quickly rebalanced to the downside. The most obvious area for a downward move could be around 70k, but I would suspect throughout this range, you either get a sharp and violent bounce, or it just feels, let's say, the the inefficient move to the upside could be just filled partially, and maybe we end up having a little bit of a low being constructed around 80k region. I mean, it wouldn't be unusual to Bitcoin, right? So for now, let's just see how the rest of the next week, and it really is all the month of January, but we're gonna get there when we talk about stocks. Bonds, again, this is the never-ending cream pie. So bad, I mean, weak. Conversely, of course, yields are still going up. Um, what about the yields? Looks like the long end and the medium part of the curve, it's being particularly resilient, if not straight out more, bullish compared to the short end. I guess this is kind of normal. I mean, in an ideal environment, you would like to see short-term rates being below medium-term rates, and both of them should be below the long-term rates. But that's your normal term premium structure, right? Uh, it is a controversial topic. It's another of those things that I don't really see how the mainstream economics would like to describe it. Essentially, I don't see it really as a term premium, because otherwise, when you see the opposite of it, like a yield curve inversion, you would talk about what? Negative? term premium. Uh, it's a bit weird, right? So I still think this is all about inflation and growth expectations. And so far, it looks like, at least for the US, the market, it's particularly convinced we're going to see inflation and growth. So this is it. Macro data are actually yet sustaining that thesis. Nothing really changed. Although, if you base these analyses on GDP alone, I already showed in the past how GDP is a. I do like to compare GDP to market cap. It's just a snapshot of what it is right now, but you get to the next month or the next quarter and everything's turned out upside down. So, you know, I don't really put a lot of weight on GDP. Now, sure, again, if you're just trying to measure the economic output of a system or a nation, then okay, you know, we need a benchmark. It's like the CPI. If you're trying to really measure inflation, CPI, it's not that good of a tool. But if you need a benchmark and everyone needs at least a common denominator and everyone will gather around it and make decisions and assessment off of it, yeah, of course, go with CPI, goes with GDP, but go with term premium definition if you like it. Let's just say, not to be so argumentative on the new year, but I would say there is a bit more into it than what meets the eye. All right. Now, let's have a look at what indices. So we got another little bit of sell-off starting out the year, but it looks like we are trying to bounce. Friday was actually a good positive day. I mean, it's good in the sense that it didn't break the previous low, right? Looking at NQ futures right here, but you could say the same for the S&P, the ES futures. Um, but overall, we are still just maybe drawing back the impulsive movement to the upside we got starting from November. Um, I mean, there are many different things you could say about the stock market in general. I have discussed extensively the weight I would put on forecasts and prediction in last week videos, so I'm not gonna go through once again. Um, if you look at it from a higher time frame standpoint, you might say they are all seem relatively cool so far, especially the majors like the Nasdaq and ES or S&P. When you look at the Dow and when you look especially at the small caps, well, not so much. I mean, there was that huge narrative about the Trump trade. Just look at the dates. November 5th, November the 6th. This is where Trump got elected. Huge, sharp, impulsive rally, early trading now, back there. So we just completely erased all these gains. So I think, since stock market, it's, in my humble opinion, more often than not, it's traded on narratives. Um, might be this the point where you start to, at least, the market starts to realize, all those expectations about the Trump policies and whatnot. Could this be that it wasn't it wasn't really a done deal as many have thought, judging by this movement into the small caps, right? It could just be that. We don't have enough time to really start to discuss Trump policies or potential policies again, but just to reiterate the obvious, just because you want to do something, it's no guarantee you're going to achieve it. Just because you want to pass a legislation, it's no guarantee you're going to pass it. And although you might think that he controls the House and the Senate, especially the Senate, the majority is particularly slim. And it wouldn't take a lot of, Republicans' defections to really cripple all these reforms type of a path he wants to go on to, right? So just keep it in mind. And I guess that's what the market is starting to consider now. Um, we got all these expectations, all these promises, but now we are facing the reality that maybe things in real life are a bit harder to achieve than what you could claim throughout the electoral campaign, right? Other than that, if we take as usual the two main ETFs as a barometer, what we see is that we are just trading in between the, if we look at the moving averages, right? We're just trading in between the 21 and the 55 on a daily time frame. And nothing, it's really, crystal clear one way or the other. Because again, if you look at the cues, we bounced two times off of the 55, but we have been so far uh, not really rejected, but we didn't manage to reclaim back the 21. So we are still in these kind of a limbo. And it's much more evident on SPY. I guess, if anything, like we said with Bitcoin a few weeks back, you might say everything or everyone would was looking at this formation right here: high, 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 lower high. So left shoulder, head, big head, right shoulder, but then it didn't break. And considering the seasonality, considering the period of the year, I wouldn't be surprised if we got a rally here, a tradable rally. Um, you know, could we go for new all-time highs? Maybe. Who knows? I'm just saying. What's the date? Uh, January the 5th. We just got two trading days. No, yeah, two. Thursday and Friday. I would still think a massive fade or a massive drop. Well, I mean, massive. Let's just say considerable drop. You could see it at around inauguration. At least, standing to previous statistics and data and seasonality type of bullshit. Um, what we are seeing right now, I guess, is a little bit of a rotation in markets because if you check the breadth of the market, we got back to that situation where the Mac 7 were particularly overappreciated and the rest of the market was just struggling, keeping the pace. So a little bit of a rotation. Like, for instance, we could check these, right? So if you look at the last 3 months, what we got: services, discretionary, financials, technology was what was more, appreciated throughout this last quarter. And if you check the last month, yeah, of course, everything is down. But if you check, it's this last 5 days, so this last drop, what you got? Hmm. Yeah, see, services are down, consumer discretionary down, materials down, but that's a theme now. Technology down. So what is up? Energy, real estate, utilities. So, I mean, energy was down, utilities were down. So it could be a little bit of a rotation we are about to see. Um, I mean, it's not bad in and of itself. I'd say a little bit of a market rotation. It's not the end of the world, especially when you get so extreme on breadth readings. But let's check this out for a moment. Now, everyone is talking about the Santa rally, which never happened. And of course, as we discussed, that has historically, starting from the 50s, a 74% probability of happening. So, 25% probabilities of not happening, it's not something you should discard, right? And it just so happened that we didn't really have that Santa rally everyone was waiting for. Now, here the interesting part of it, because Wall Street is full of claims and sayings and whatnot. So you got the one about Santa Rally, and then you got the other one about the 5 days, the first 5 trading days of January. It is something similar. While you read into it, I'm gonna try to remember the old saying. It was like, so goes the first 5 days, so goes January, so goes the year. And as you can see in here, the month of January is called the January barometer because historically you tend to look at these period of the year as a trifecta type of a phenomenon. So if you got both Santa Rally, the first 5 days, and the month of January on a positive side, you're going to have very good returns throughout the year overall, year to year, for the index. While, the more one of these trees starts to give in, the less and the more subdued the returns are for the year. It doesn't necessarily mean that you're going to have actual negative returns for the year, but just, disappointing type of stuff. So just bear in mind that just because you didn't have the Santa Rally, that doesn't mean that the year is going to end up down. All right. And there is from the almanac of trading, I guess. Yeah, stock traders almanac. You got this nice data set, and if you want, you can either go there and download the image yourself, or you could just check this one out, take a screenshot of it if you just want to post it on your wall to remember what history says, right? Um, it is also true we got basically back-to-back 20% plus gains for the S&P, especially over the last 2 years. So let's check what usually happens after after a back-to-back 20% gain. So as you can see, it doesn't necessarily mean you're gonna have a down year, but things tend to tune down a bit. Uh, and again, that doesn't necessarily mean that just because you have 2 years of back to back, you cannot have a third and a fourth year, right? As it was in basically 95 to the end of the 90s. Well, you might say, okay, but that was the dot com bubble, or at least we were approaching the dot com bust. Yeah, all right. So what? Numbers are just numbers. What if this is the middle stage of the AI bubble or mania or whatever? So again, just you know, it's always the same thing. Statistics and seasonality and whatever type of assessment you want to make about long-term trends are always useful as a general guidance, but don't take them as a said and done deal because just because it was like this in the past, that doesn't mean that this time around we are not going to get events or dynamics which are completely going to turn all the table upside down. And again, keeping on being on the side of Wall Street sayings, you know, past results are not guarantee of future performance. So at a point you start to wonder why are we wasting so much time looking at all this shit while at the end of it nobody knows what's going to happen into the future. I guess it's human nature. We try to seek certainties, same as the market does. And of course, at the end of it, the market is made out of people, so we are all one of the same, right? And we try to look at what happened in the past to grasp what might come into the future. Is it better not to do it? No, I wouldn't go that far. I wouldn't say it's completely garbage and you shouldn't look at it. I mean, I said it is completely garbage and a waste of time to look at Wall Street analysts' type of forecasts and outlooks. But as for the past, I mean, these are real data. This is real stuff which happened in the past. So one thing is having a clear picture of that, Another is betting your farm on the fact that same as it happened in the past with the same timeline and with the same type of dynamics is going to happen the same this time around. This might be the day of good old sayings because history tends to rhyme, but it never really repeats itself exactly the same, although it rhymes. It's kind of the same, right? So, yeah, I got another one, same thing. I just think this one it's a bit clearer than this one, but they are just showing you the same type of stuff for the back-to-back 20% returns. Um, the thing about the breadth of the market could be summarized with these, and we tend to see these throughout periods of time into markets, or in this case, the stock market. We got a market which can get particularly concentrated in one sector or a few stocks. This is just getting back over the last decade, of course. So again, it's nothing new, and it just it highlights the risk. It highlights the risk of a potential correction. Now, again, there is a distinction in between what a correction could be and what a crash could be. So just don't confuse the two because they are very different phenomena in nature. But nonetheless, it's useful to notice that when the market it's particularly concentrated only one sector, what you can get is, as we were saying before, a little bit of a rotation. And again, rotation, it's not bad per se, but it can move markets around in the short term. So just pay attention to it. All right. What else? I guess it's a little bit of one and the same. We are looking at the S&P compared to the equal weighted S&P. You could also do it yourself. You just go onto TradingView. You could type in SPY, so SPY for the normal market cap weighted index, and then you add on top of it, I guess is RSP for the equal weighted ETF. The ticker should be that one. Uh, Let me check real quick. Do I have a chart? Yeah, this is, let's see, RSP, if I can spell it right. Yeah, RSP, equal weighted ETF, traded at the New York Stock Exchange. So, I mean, if you want to go and make these assessments for yourself, that's a good ticker you can compare to the normal SPY ETF. Um, yeah, again, Max 7 really outperforming all the rest. So, you know, and again, that old relationship in between the S&P and the Nasdaq compared to the small caps, right? So nothing new. Again, you're just looking at things we have been looking at for months now, and other people before me probably for years. So, yeah. But this is interesting. All right. So you remember that semi rant I had about analysts trying to convince you in putting money here and there. And I specifically quoted, if you remember, yeah, your family banker is going to tell you, let's diversify, let's invest in international, let's put a bit more capital, let's allocate a bit more into China. Now, over the last decade, this is what you get when you compare a lot of different type of markets. The Nasdaq and the S&P are just the kings when it comes down to returns, right? And bear in mind, we are not looking at, yeah, I mean, there is a chart for international right here, but it doesn't really make it justice. If you could just isolate, I had that screenshot, but I don't know where I put it, to be fair. Maybe next time. But if you isolate China over the same amount of time, if my memory is serving me well, I guess the return on a buy and hold type of investment was less than 3% over 10 years. So again, And the same thing could be said, I mean, the same logic could be expanded when you think about the two main markets in the US and the implications and the interconnections within these and the dollar. Because let's have a look at currencies, right? Real quick. So what we got, dollar, well, I mean the DXY, not really the dollar, the DXY, right? Still strong, still going up, and conversely, everything else is going down. Um, so this is for the main European pairs against the dollars plus the Japanese yen. So the wrecking ball is still ongoing. And if you expand your view throughout other markets, let's say the BRICS, what you get? Not cool, right? I mean, we already know about the currency crisis in Brazil and all the shit going on in China with the central bank of, sorry, India, the central bank of India trying to short to short the dollar in the offshore market with non-deliverable type of instruments in order to try to alleviate the pain off of their own local currency, and it's not working out. Chinese, what did the Chinese did? um it looks like they give in. I mean, they tended to have these kind of a line in the sand, and it was around 7:30. Now you can't see that because you would need to invert the ratio, but uh, let's put it this way: if you look for another chart of the Chinese yuan against the dollar, maybe inverting the two, you would see that there was a point where the yuan was quoted at 7:30 against the dollar. So what that means is that you needed 7.20, 7.30 yuans to buy a dollar. And that was kind of a line in the sand for the Chinese authorities. They said, yeah, you know what, 7:30, it's not a level we want to see cracked. And they kind of moved the mechanism of pegging the currency against the dollar. They try to target the 720 level, but now we traded back down to 732, I guess. So I mean, it looks like they are giving in. And although all the stimulus, all the bazookas they came up with, it's not really working. Uh, and even I guess at a point even the Hang Seng it's gonna come down a little bit, and everyone betting on these China stimulus, yada yada. I guess they're gonna be disappointed a little bit, but you know, no one it's really holding up well against the dollar. Oh, and by the way, just as a proof of concept, if you check the date, May the 8th, 2023, that was just the chart I came up with for the DXY and the potential developments into the future after the initial spike off of well, you got the pandemic and then you got the Fed hiking rates and whatnot. But this is a long-term trend. And guess what? Started out in '08 when everyone was saying the dollar is doomed, the system is fucked. Yeah, maybe, but there are many different ways to quote unquote, and pardon my French, to fuck a system or to disrupt a system. And it looks like even if you want to assume the system is going to end, I'm talking about the dollar system, the monetary system, uh, the global system based on globalization of trades and cooperation internationally, right? Even if you assume this is going to be erased and obliterated, the way it's going to be obliterated, it's probably with the dollar going up, not down. Just it's like with human behaviors. Um, if you think of it, why from time to time, why do you feel the need of a change? And most importantly, when do you really take actions in order to change something? Well, that is usually when the pain of changing is less than the pain of maintaining the status quo. So in this dollar system we got, yeah, I mean, I'm sure a lot of countries, like all the BRICS, all the countries which actually lost in the globalization process, all these countries would like a change. The problem is that changing on a net balance, if you look at the cost benefit analysis, changing was even worse than actually staying on course. So they never actually did it. Um, but if the dollar starts to crack to the upside and the pain of being into the dollar system starts to be so huge, at that point you're gonna say, you know what, fuck it. I mean, I'm fucked anyway. So at this point, it's it's worth to give it a try and try to implement a new system. I mean, pain for pain. I'm gonna exchange pain for pain. All I know is that the pain I'm suffering now, there, I mean, I couldn't imagine something worse. So let's try to change. That's how the system would likely end, unless another Plaza Accord 2.0 or whatever. But just as a proof of concept, I'm still running off of this assumption that the dollar is set to go higher. Now, how? I mean, it's going to be a straight line? Probably not. And I guess, if you start to look at it on a weekly time frame or on a daily time frame, are we due for a little bit of a correction into the dollar? I mean, yeah, maybe, but what type of correction? Could be something like this. The dollar basically, since when we got the anticipation of the elections, started to go on a rally. It was ordered, it was steady. So, I mean, a lot of people are reading into it. This is just the bet that the markets are making on the US keeping on growing, outperforming the rest of the world, and being the happy, isolated island where you got economic growth, while in the rest of the world you're not going to see economic growth. Contrary to it, you might see already right here, right now, a lot of different countries on the brink of recession. Is it the reason why the dollar is going up? I mean, it could be part of it, as part of it could be the interest rates differential, but my best bet are always on the US denominated debt around the globe and on the fact that if you get into a situation in an environment where the world starts to be a bit more fractured geopolitically, economically, from a global trade perspective, what you get is a slowdown in dollars flow all around the globe. And, that debt need to be served, needs to be paid down, rolled over. And if you don't get the dollars to do it by global trades, the other alternative you have is basically either selling your local currency and buying up the dollars you need when the debt denominated in dollars comes due, or since we foreigners we got reserves, right? From global trades, we get the dollars, we export stuff into the US, we get the dollar we need, and then we kind of stock up on US treasuries as a reserve for the rainy days. So, look what happens when the rainy days actually come. We are forced to sell our reserves because these assets are denominated in dollars. So if you are so desperate for dollars, we're going to need to completely unload our reserves and get the dollar liquidity that we need. And again, these goes hand in hand with the fact that the Fed went for the most violent hiking cycle in history, which contributed to reprice down the existing treasuries and bonds in circulation. So why the dollar is going up, why the bonds are coming down, why the yields are still climbing higher. It's all connected, and it's all based, I guess, in my opinion, on a narrative that the US are going to see economic growth while the rest of the world won't. I personally believe that that narrative will come to an end for the same, by the same nature of the system. If everything it is interconnected, how can you get just one nation thriving while all the rest of the system is struggling? Just, it doesn't need to be particularly specific, but just a quick example, thought experiment. You get the dollar keep on climbing to the upside, and you get at the same point the Chinese yuan keep on plunging. Now, if you check, and this is just to reiterate how much the system can be interconnected, if you check what happened over the last 10, 20 years, Chinese growth has been a major driver for global real estate markets. What do I mean by that? Well, you are Chinese, you're making a hell of a lot of money by producing at a cheaper cost and selling out your products to the US, so you got a lot of dollars coming into China. Now, sure, the Chinese government or China as a country might reinvest those profits and recycle them back into the treasuries as reserves and to get a bit of yield on it, right? But think about the private sector. The private sector saw a little bit of an outflow of those money. Those money, where were they going? Well, Australian real estate, Canadian real estate, right? So what happens if the Chinese economy gets so fucked, and God forbid, since they are communist, the government start to demand yuan's repatriation or Chinese assets repatriation? All those real estates purchased in Canada and Australia by Chinese, they are going to need to sell them. If they start to sell, and if they were the marginal buyers lifting higher the real estate market in Canada and Australia, what you get is a drop in the Australian and Canadian real estate market. And since they are both nations kind of like with this type of a American English type of a mentality where you tend to have a lot of your net worth in your house, or you tend to leverage your house equity to finance your spending, what's going to happen if the real estate market drops in those states? So when you look at the dollar and you think that just because it's going up, it's good for the US and it's bad for all the rest of the world, you need to think 3, 4 steps ahead of it and think about what the implications might be in the medium term and how it could all boomerang back to the US one way or the other. Now, again, does it mean the US are going to be in a massive recession, a dot-com bust, or a 2020 March recession, or 2008 2.0? No. I mean, again, it just means that the risks for a downturn in the US are not completely off the table just because all the cracks are manifesting themselves outside of them. If the system runs on dollars, it's normal that when you got, hiccups or problems in that very system, the first places where you're going to see them is going to be in the periphery. And what are we looking at? China, Brazil, India, Russia to some extent, Europe. I mean, we could stay here and sitting nicely, sipping a little bit of beer and thinking the US is never going to be affected. But I'd say if you are completely discarding that risk, I mean, no offense, but you're just naive. All right. So again, bear in mind. And again, look, the another thing could be the dollar milkshake theory. You tend to see while the dollar went up, right? At the same time, The stock market in the US went up because, of course, a strong dollar attracted a lot of capitals in the US, right? And at the same time, gold went up again because of what? What's the only thing I could do, especially if I'm a foreign central bank, to offset the dollar crashing my own currency? I'm gonna load up on gold, which is the only thing I'm allowed to buy as a central bank, and is the only thing I see on the board which is outperforming the dollar. So in a way, if I'm increasing my holdings of gold, I'm kind of shielding my balance sheet against the dollar going up, US Treasuries that I got a ton of them going down in price. If I put gold on the other side of my balance sheet as an asset, right, I kind of set the depreciation in the holdings of US Treasuries that I got, and my currency being fucked against the dollar. And I'm basically building up some sort of an insurance policy, so if things really go south, I can still liquidate my gold and get the liquidity that I need. What could I sell my gold for? Well, if you look at the chart, it's priced in dollars. At least the majority of it is priced in dollars. So it is all connected as usual. Just don't take things in isolation. All right. Again, you might be worried about. When people think about a potential problem for the U.S., they're all betting on this debt crisis. Now, as we've seen for the bonds, uh, being a bond holder might not be pretty, but just to point out a tiny little thing, right? Um, I got this blue line in here, right? That is basically November 21 when they in the US went for the start of the rate hiking cycle, okay? And I got these both on the euro, which is my own local currency, on the DXY, just when, if you see, it broke out these highs right here, retested them, retested them, and went for the parabolic move to the upside, right? And I got them for the pound sterling, I got it for Japanese yen, and for the Canadian dollar. Now, it's interesting because if you check, let's say, something like this is 3 months treasury, and this is the yield on a 3 months treasury. So if you check, starting from when 2022, right? They started to hike and to basically what was November they gave the official announcement. I guess I remember it because it was the top in Bitcoin. All right. Um, and you see the yield starting to go up from basically 0% up to four shit. It touched 5.45%. So from 0 to 5% is a hell of a move. But what's interesting when you start to consider why people which are thinking of the US government being unable to fund himself, it's just look, if I'm European, I'm buying in a money market fund and they are continuously rolling over those money into short-term bills and I get paid incrementally, right? I always make more money if I'm starting doing it. And for a long enough period of time, I got 5% plus yields on my money in a money market fund. The thing is, you might say, if you live in the US, well, I mean, who cares? At the end of it, we got inflation ramping higher, and that completely offset the gains that I could make in the T-bill market or in a money market fund. Yeah, I mean, that is true for you, but for me, living in Europe, that was a blessing being able to take advantage of it because if you look over the last 3 years, having something which is yielding a range of 4.5% or 5% or 5.5% on a year over year base and compounding that gain over 3 years, while at the same time even if we are not really at extreme levels, I still see the euro down almost 12% against the US dollar. And those T bills pay you in US dollars. So I'm not getting 4.5%, 5% year over year return compounded. No, I'm getting that. And since I'm European, I'm getting that plus the 12% gain that I get by being paid in dollars while the euro falls 12% against the dollar. And it's the same throughout all the other major currencies. Look, uh, Canadian, Japan. If you are a Canadian or a Japanese, would you think, would you spit on these free money? It's fucking free money if you think of it. Short-term duration, high yield, and at the same time, I get the price appreciation of the profits. The profits are denominated in a currency which is appreciating against my own. So I'm not making 4% or 5% year over year. I'm making double digit returns. And the risk, I mean, what what risk assessment would you make about the US government going insolvent or in default? First of all, while all the rest of the governments on earth are actually kind of cool now, very little. I mean, if the US defaults, all the rest of the world would be defaulted way ahead of it. Guess why? Because the system runs on dollars. Who's the only one which has the printing press for dollars? Oh, it's the US government, right? The rest of the world has a massive US denominated dollars problem. They are leveraged on, on the dollar denomination, but they don't have the printer for it. So when you start to put all these points together, you see why for a foreigner, the US dollar, the US Treasury market, it's still very much attractive. So, we always default back to the dollar because, again, I guess you can't really make a sense of global macro if you don't make a sense of the dollar and the implications the dollar has in the system when you look at it relative to all the other currencies around the globe. Uh, the argument of, yeah, I mean, the dollar is the dollar, but it's just another fiat currency. It's going to go to zero one of these days. Yeah, but I'm interested in what's going to happen in the meantime. And if you think that, just, I don't know, buying gold, buying Bitcoin, it's the solution to all your problems, I might say you want to think again. It might be the solution over a long enough period of time, but how do you navigate all the other things in between is the real deal. So again, this is why I think it's always useful to check currencies. Or it might just be that I started out as a currency trader, so I'm still keeping a little bit of it. But ending up on the topic of potential and disruptive shit for this new year, I found this tiny little chart. It was really a survey, and it compares the worries that people had into at the end of 2023 getting in 2024 and now at the end of 2024 getting in 2025. So it's pretty straightforward, right? um, at the first spot, still got the same global trade war, AI bubble, yeah, right. Just read a little bit into it. But what's interesting to note is that if you check the darker blue line, the huge concern about last year was a US hard landing, followed by central banks hiking again because inflation is sticky. Um, and so, did it come to fruition? Those huge fears? I guess not. Uh, AI enthusiasts, I mean, yeah, we got a little bit of a correction due to a rotation throughout 2024 in the tech sector, but if you check overall, if you look at, you know, throughout all the year, the tech sector performed particularly well. So again, all these fears, it's always the same thing. If a simple survey like this could grasp these fears, you better believe the rest of the market it's already grasping it and it's already urging for it. So if you're looking for a black swan, you're not gonna find it in here. You know, to some degree, I would pay more attention on what the general public it's not deeming as a high risk to disrupt market. Incidentally enough, what do you get? New pandemic. Hmm. Uh, Emerging market crisis. We have just looked at a few currencies and a few situations in the rest of the world outside of the US, right? And what? Real estate, it's now particularly low for 2025. So, I mean, if I had to, gun to my head, if I had to pick a few risks from this chart, I would pick the ones which are not that highly weighted. Still, still thinking it's probably not gonna be that the one thing which send the market potentially lower 20, 30, 40%. It's always the exogenous event. But if you really want to hedge against something, I would pick these ones because the rest it's already known. And if it's known, it's hard to to come to a massive disruption in markets when everyone is looking at the same thing and they're already planning on how to deal with it. All right. So as for the rest, 2025, briefly, what do I expect? A lot of volatility, to be completely honest. I I'm not gonna stay here making outlooks for year end. I'm not saying, yeah, gold is gonna hit this, Bitcoin is gonna hit that, the stock market is gonna hit this and that. No, I mean that's not what I do. I just judge these charts week by week, or at least day by day when I'm day trading. But I, it's not in my nature, and it's not even my job to come up with such long-term type of predictions. I think it's going to be volatile. I think there are many things which could shake markets, either up or down. Most of it, in my view, it's going to be related to the energy situation and, of course, geopolitics. We're going to see the unfolding of this Trump new term and all these narratives which were and expectations which were built up on it, and the threat of tariffs. Now you now you got a new one. Now you got Trump not only making or at least wishing to make Canada the 51st state, but also wanting to buy up Greenland. Um, which beyond the geopolitical, it ties in a little bit with energy, right? God knows what there is in the ground of Greenland when it comes down to rare earth, metals, hydrocarbons. And now with the new technologies we got, maybe it, those reserves weren't exploitable 20 years ago, but now maybe they are, and they could represent a new way of assuring raw materials, production inputs, and cheap energy for whoever is going to be able to put his hands on it first. Not to mention, I mean, if you look at the international traffic when it comes down to airplanes, um, a lot of planes actually fly above the North Pole in order to get from one place of the world to the next because you know it's easier, it's quicker, and therefore it's cheaper. So I mean, I don't see a lot of people looking at it. Everyone is concerned about the Middle East, Taiwan, and whatnot. But what if the core of the geopolitical game is going to move itself onto the North Pole, right? Again, so all of this brings me to the conclusion that no matter where the market goes, I still think we're going to see a bit more of volatility this year. And as a day trader, that's all you want. So that would be me when it comes down to predictions and outlooks. Nothing more than that. I'm not stretch myself farther than that. That is it for me. Hope you're gonna have a good year, and hopefully you have also a nice end of 2024. We're gonna see how this crazy year is gonna unfold itself. But for now, this is all, and hope to find you back next week. Have a nice rest of your weekend or your Sunday. Be nice and be cool. Nils out.